You're welcome to another edition of LoudTech Open and Distance Learning Center. This is ACT 302 Cost Accounting 2. I'll be taking you through study session 5, that is standard costing technique. Standard costing technique may either be viewed from the perspective of marginal costing technique or absorption costing technique, as you have learned in study session 4. By relating standard costing technique with marginal costing technique, variance analysis will be determined on the total relevant cost of products, excluding fixed overhead. But if it is viewed in the context of absorption costing technique, the variance analysis will involve the total cost of products to the organization. At the end of this study session, you should be able to define standard costing and discuss the objectives of standard costing. 2. Explain the types of standard and the steps involved in standard costing technique. 3. Discuss the advantages and disadvantages of standard costing. And lastly, explain and determine standard cost variances. Meaning of standard costing. Standard costing is an important subtopic of cost accounting, which is usually associated with a manufacturing company's cost of direct material, direct labor, and manufacturing overhead. Rather than assigning the actual cost of direct material, labor, and manufacturing overhead to a product, many manufacturers assign the expected or standard cost. This means that a manufacturer's inventories and cost of goods sold will begin with amounts reflecting the standard cost, not the actual cost of a product. Manufacturers, of course, will still have to pay the actual cost. Standard costing is the practice of substituting an expected cost of an actual cost in the accounting records and then periodically recording variances that are the differences between the expected and the actual cost. This approach represents a simplified alternative to cost layering systems such as the FIFO-LIFO method, that is first in, first out, and last in, first out methods, where large amounts of historical cost information must be maintained for items held in stock. Factors affecting the formulation of standard costing. The following are the factors to be considered in the formulation of standard costing. 1. Equipment age, equipment setup speed, labor efficiency changes, labor rate changes, learning curve, and lastly, purchasing terms. Let's take this one by one. Equipment age. If a machine is nearing the end of its productive life, it may produce a higher proportion of scrap than was previously the case. Now, the equipment setup speed. If it takes a long time to set up equipment for a production run, the cost of the setup as spread over the units in the production run is expensive. Hence, if a setup reduction plan is contemplated, this can yield significantly lower overhead costs. Labor efficiency changes. If there are production process changes, such as the installation of new equipment or automated one, then this impacts the amount of labor that will be required to manufacture a product. The next is the labor rate changes. If you know that employees are about to receive pay raises, either through a scheduled raise or as mandated by a labor union contract, then you need to incorporate it into the new system. This may mean setting an effective date for the new standard that matches the date when the cost increase is supposed to go into effect. Learning curve. As the production staff creates an increasing volume of a product, it becomes more efficient at doing so. Thus, the standard labor cost should decrease, though at a declining rate as production volumes will increase. The last is the purchasing terms. The purchasing department may be able to significantly alter the price of a purchased component by switching suppliers, altering contract terms, or by buying in different quantities. Objectives of standard costing. The following are the objectives of standard costing technique as highlighted below. 1. To improve a basis for estimation. 2. To provide guidance on improving performance. 3. To provide a basis for assessing performance and efficiency. 4. To assist in setting standards. 5. To control costs by establishing standards and analyzing variances. 6. To motivate staff and management. And lastly, for valuation of stock and work in progress, profit planning and decision making. Types of standard. In practice, there are 4 different types of standard. 1. Ideal standard. 2. Attainable standard. 3. Current standard, and last, the basic standard. Now, ideal standard. This is also known as unattainable standard. It's an established standard specifically designed on the basis of maximum productive capacity of the organization. That is standard established without providing adequately for any negative factor that may inhibit the attainment of the standard, such as we have labor standard established without provision for lateness, absenteeism, industrial action, annual leave, and even maternity leave. Hence, ideal standard is specifically designed to demotivate workers because they are not achievable in nature. Attainable standard. This is also referred to as a practical standard. It is an established standard that is specifically premised on what is considered practicable within the organization. It is established with the adequate provision for negative factors that may affect the attainment of the established standard, such as the provision for ideal time, machine breakdown, loss of power, lack of raw materials, industrial disputes, repairs and maintenance of machineries, etc. Current standard. This is described as an established standard specifically based on the prevailing working condition within the organization or industry at large. Current standard are subsequent to frequent changes in order to reflect the current position within the organization. Next is the basic standard, and this represents an old established standard that is designed specifically to satisfy a given objective. Hence, basic standards are not subject to frequent alteration, therefore they are outdated in nature. Steps involved in standard costing technique. The following are the basic steps to achieving a good standard costing technique. We have 1. Identify the long-term corporate objective of the business. 2. Determine the short-term achievable objectives. 3. Conduct a market research to identify the specific needs of the customers. 4. Design a particular product or service that will satisfy the need of the customers. 5. Obtain top management support for standard costing technique. 6. Identify the quantity and quality of raw materials in producing a unit of the product. 7. Estimate normal loss in the cost of production. 8. Identify labor rates per hour and the standard hour required in producing a unit. 9. Adopt a method of absorbing both variable and fixed production overheads into product costing. And lastly, prepare a standard cost card. Advantage and disadvantages of standard costing technique. The following are some of the advantages of standard costing technique. We have 1. Budgeting, inventory costing, overhead application, and price formulation. Budgeting. A budget is always composed of standard cost, since it will be impossible to include it in the actual cost of an item on the day the budget is being finalized. Also, since a key application of the budget is to compare it to actual results in subsequent periods, the standards used within it will continue to appear in the financial reports through the budget period. Inventory costing. It is extremely easy to print a report showing the period end inventory balances, multiply it by the standard cost of each item, and instantly generate an ending inventory valuation. The result does not exactly match the actual cost of inventory, but it is usually close. However, it may be necessary to update standard cost frequently if the actual costs are continually changing. Hence, it is easiest to update cost for the highest value component of inventory on a frequent basis and leave lower level items for occasional cost reviews. Overhead application. If it takes too long to aggregate actual cost into cost pools for allocation of inventory, then you may use a standard overhead application rate instead and adjust this rate every few months to keep it close to the actual cost. Next is the price formulation. If a company deals with custom products, then it will use standard cost to compare the projected cost of a customer's requirements, after which it adds on a margin. This may be quite a complex system where the sales department uses a database of component costs that change depending upon the unit quantity that the customer wants to order. Disadvantages of standard costing technique. 1. Cost plus contracts. If you have a contract with a customer under which the customer pays you for your cost incurred plus a profit known as the cost plus contract, then you must use actual cost as per the terms of the contract. Standard costing is not allowed in this situation. Driver of inappropriate activities. A number of the variances reported under a standard costing system will drive management to take incorrect actions to create favorable variances. For example, they may buy raw materials in larger quantities in order to improve the purchase price variance, even though this increases the investment in inventory. Similarly, management may schedule longer production runs in order to improve the labor efficiency variance, even though it is better to produce in smaller quantities and accept less labor efficiency in exchange. Next is fast-paced environment. A standard costing system assumes that costs do not change much in the near term, so that you can rely on standards for a number of months or even a year before updating the cost. However, in an environment where product lives are short or continuous improvement is driving down costs, a standard cost may become out of date within a month or two. Slow feedback. A complex system of variance calculations are an integral part of a standard costing system, which the accounting staff completes at the end of each reporting period. And if the production department is focused on immediate feedback of problems, for instance, for instant correction, the reporting of these variances is much too late to be useful. The last is the unit level information. The variance calculations that typically accompany a standard costing report are accumulated in aggregate for a company's entire production department, and so are unable to provide information about the discrepancies at a lower level, such as the individual work cell, batch, or unit. Standard cost variances. Meaning of variance. A variance is the difference between the actual cost incurred and the standard cost against which it is measured. A variance can also be used to measure the difference between actual and expected sales. Thus, variance analysis can be used to review the performance of both revenue and expenses. Now, types of variances. We have basically two types of variance analysis. One, we have the rate variance and the volume variance. A rate variance is also known as the price variance, and it is the difference between the actual price paid for something and the expected price. multiplied by the actual quantity that is being purchased. The rate variance designation is most commonly applied to the labor rate variance, which involves the actual cost of direct labor in comparison to the standard cost of direct labor. The rate variance uses a different designation when applied to the purchase of materials and may be called the material price variance. That is, rate or price variance is equal to SP minus AP times AQ, where SP is the selling price, AP is the actual price, and AQ is the actual quantity. Next is the other type of variance. We have the volume variance. A volume variance is the difference between the actual quantity sold or consumed and the budgeted amount multiplied by the standard price or cost per unit. If the variance relates to the sales of goods, it is called the sales volume variance. Where it relates to the use of direct materials, it is called material yield variance. If the variance relates to the use of direct labor, it is called labor efficiency variance. Finally, if the variance relates to the application of overhead, it is called the overhead efficiency variance. That is, volume variance is equal to SQ minus AQ times SP, where SQ is the standard quantity, AQ is the actual quantity, and SP is the standard price. Worked examples on rate variance and volume variance are available in your study materials. I hope you had a wonderful time listening. Thank you.